What is liquidity? How to mechanically identify liquidity pools, how to spot institutional trading activity, liquidity inducement, how to trade high probability liquidity zones, how to avoid liquidity traps so you can start taking advantage of them instead, and how to enter and exit for maximum profit, high and low resistance liquidity, and the advanced liquidity cycle. So before we dive into the specifics of the liquidity concepts, first you need to understand my overall strategy philosophy. So my entire technical strategy is based around the idea of trying to identify where the big money is entering and exiting the market and then try and trade in line with that. So first I use market structure, and that gives me my directional bias. Once I know the direction I want to trade in, I then use supply and demand zones to help me locate where I'm going to enter that trade idea. And then finally, I use liquidity to help me time and refine that idea. So I essentially use three main time frames: my higher time frame, my medium time frame, and my lower time frame. With my higher time frame, I just want to know, are we currently in the pro trend run phase, or are we in the higher time frame pullback phase? Okay, that's it. Step two, my medium time frame, I want to know where is my immediate directional bias. So if my M15 chart is bearish, that is the direction I want to trade in for the session. And also that is the time frame I use for my zones, for my POIs. Okay, so my medium time frame gives me my immediate directional bias, and the zones are where I need to trade from. Once I have my directional bias, so i.e. the higher time frame pullback is complete, my medium time frame has now shifted bullish, therefore the higher time frame pullback is now finished. So now I want to follow the bullish medium time frame until it takes out the higher time frame week high. Okay. Now, if you want to understand how I fully use market structure, supply and demand, and my entire strategy, building it from the ground up, click the link in the bio and we have a full free training video series for you where we cover everything from end to end, including how to build a trade plan, back testing, market phases, all of the advanced stuff. Sign up in there, it's completely free, and you'll take a ton of value from it. So once you've identified your directional bias, so the M15 is now bullish, we want to be looking for catching that higher low to now target the continued bullish move all the way up to that higher time frame high. Okay, we have our supply and demand zones, and now we use our liquidity concepts to refine those zones and to know what requirements we need to see when price gets there to increase our strike rate, to increase our risk to reward. So that's what we're going to cover in this lesson today. So what actually is liquidity? Well, in its most simple terms, liquidity is just how much supply and demand there is in a market at every price level. On the left here, we have a very liquid market. So you can see that every single price level, there is a lot of volume on both sides of the market. Whereas in an illiquid market, there isn't, right? There's a lot less volume at each price level. Some price levels, there might not be any volume, right? Now, in trading, every time you take a trade, there must be an equal and opposite order for you to transact with, otherwise a trade can't take place. So if you're trading an illiquid market, and imagine you're a big guy, right? I mean, these are made up numbers, but imagine you're putting a lot of volume through the market and you want to buy $700,000 worth of whatever the asset this is, but there's only $500,000 at the current ask price. If you buy that, price is going to have to shoot all the way up to this price level to completely fill your order, right? So in an illiquid market, the market is going to move a lot quicker. And that means that if you're a big guy and you're getting involved, you're going to get a lot of slippage because your order is not going to get filled up all the way up here when you're trying to buy down here at the current market price. So before we're about to dive into kind of these fancy technical liquidity concepts, get your head around this. The big guys need a ton of opposing liquidity for them to trade against in order to reduce the amount of slippage they will get in the market, okay? So this is a massive clue of now what we need to try and identify on our charts to look for where are these big liquidity pools going to be. So if you look at any candlestick chart, right, at every single price level here, there's going to be a ton of supply and demand on either side of the market, okay? So how do we now refine that to identify where the big pools of liquidity are going to be, where institutions can potentially be looking to trade against that? So we want to identify the areas on our price charts where we think there is going to be large pools of resting available liquidity for institutions to use, okay? So we assume that there is liquidity behind every structural high and low in the market. Now that can come in many forms as it's shown on the chart here, but essentially the more significant that high or low, we can assume the more available liquidity there will be behind it. Now, there's a lot of sort of discretionary ways that this can appear. You've got trend lines, equal highs and lows. You can have, session range liquidity, say with the Asian session range, previous day highs and lows, right? There's lots of different ways that traders like to use. And that's why when you'll see in other YouTube videos, traders will just draw liquidity everywhere. Now, whilst that might be factually true, how does it help you with your trading, right? You want to make it as systematic, refined, and mechanical as possible. So what I would advise to you when you're starting out is just focus on something like the strong high and low concept, because this is extremely mechanical and simple to identify. Now, behind these highs, we assume that there is buy side liquidity, and below these lows, we assume there is sell side liquidity, okay? Now, why do we get these liquidity pools forming behind these structural points in the market? Well, that's where the concept of inducement comes in. So inducement is a thing that persuades or leads someone to do something. So in trading, what that essentially means is that patterns in the market will encourage market participants to trade at certain levels. And what that does is it generates available liquidity for the big guys to use to fill their positions. Okay, so for instance, imagine you get equal lows in the market, these double bottoms. What does that form? It forms a support level that traders might want to trade. So if they're buying at that support level, where are they going to place their stop loss? They're going to place it below the lows. Okay, so that generates sell side liquidity. Likewise, people might view that double bottom actually as a bear flag, and they want to sell the breakout of that, right? So more sell side liquidity generated below those lows. Or for instance, you get a low that breaks a high. Traders now see the trend as going to the upside. So they now want to buy here, hoping that that bullish trend will continue. So if they buy there, where is their stop loss going to be? It's going to be below the low, and that generates sell side liquidity. You then get the opposite for those bearish patterns, right? Generating buy side liquidity above the high. So again, what are we doing here? The institutions need opposing liquidity to fill their orders. So if you look for these patterns to appear in areas in your chart where you're expecting a certain direction to play out, i.e., if you identify a high probability supply zone and you start to see those structural highs form in front of it, then we know there is buy side liquidity, right, for the big guys to sell against, right? They need that opposing liquidity to enter the market short with minimal slippage. So the key here is identifying inducement that generates the available liquidity for institutions to use in front of a POI, right, can increase the probability of it holding and for price playing out in that direction that you're anticipating. So this is a powerful concept when you understand it, but on its own, it's pretty useless. Like anything in trading, you need to combine it with all of your other confluents to build a portfolio of evidence to take a high probability trade. So now we understand what liquidity is, where we can find it on our charts, why institutions need it, but now how can we use all of that to actually make money? If I can simplify it for you, there's two main ways we use liquidity. One is in the past, okay? So we look for where sweeps have already occurred to signal that institutional activity may have happened there. And then we use it for the future, okay? So identifying where is the available liquidity to anticipate if they're going to enter in those same places in the future. So the first part is where have they previously entered? And that's where the concept of liquidity sweep zones come into play, okay? So if you find a supply and demand zone that took liquidity in the creation of the zone, that can signal that there was institutional backing in that zone, okay? Why? What is the logic and theory behind this? Well, if we assume that there is buy-side liquidity behind a high, that means that institutions can use that to sell against, right, to fill their orders with minimal slippage in the creation of this zone, okay? So there's different ways in which this can form, but if we see that zone that took a low, right, in the creation of that demand zone, that is potentially where BFIs have used the sell side liquidity to enter to get in long. Okay, so now you can use this as a filter to look for high probable zones within your trading. Now we know that in a bullish market, lows are strong because they create those highs, they break structure to the upside. Now what you will often notice is that those strong lows in a bullish market are created through sweeps of liquidity. Why? Because institutions need the sell side liquidity below those lows in order to fill their long positions to fuel that next pro trend run to the upside, okay? So if you look here, you can see that every time a swing pullback is complete, It happens through a strong liquidation, right? We take that liquidity in the leg to the left. We even get a low here that breaks the high, okay, generating strong available liquidity below that low. The big guys can then use that to get long and fuel that next movement to the upside, okay? So you can just see it again. Every low takes liquidity when it's formed. Again, we come down, we take liquidity in the formation of the zone. If I zoom in here a bit, right, sometimes it's a bit more subtle, but we get this supply to demand flip. It takes liquidity to fuel that next move up, okay? Not quite enough to break structure. We come down, grab the liquidity into this POI, and we get that next movement to the upside. And you'll see that time and time again. We get the liquidity sweep before we get that next movement to the upside. Here we get equal lows into our POI, increasing the probability that that next strong piece of structure is going to form, rinse and repeat. So identifying zones that will form through sweeps of liquidity is a great signal that there was institutional involvement there. So when you're trying to refine what potential zones you want to trade from in the future, they are great things to look at. So that's looking in the past, but now we look into the future and go, where is there available liquidity that institutions may potentially use for us to then try and trade in line with that direction? Let's take a look at that. So sweep zones show us potentially where they entered previously. The concept of inducement will show us where the available liquidity is for them to use if they're going to enter again, okay? So if there is no available liquidity to the left, there's no structural low to the left, and if there's no structural lows built to the right, there's no available liquidity. Where is the available liquidity? It's going to be behind the zone itself, okay? And that's very often when you will see zones fail, okay? So here, in the example, no liquidity to the left, nothing built to the right. The only available liquidity for the big guys to use to sell against is behind the POI itself, and that's where you see that trap and the zone get swept. Now, on this occasion, right, the top zone doesn't have any liquidity to the left and nothing to the right. So now the available liquidity is behind that zone, and we can use that sell side liquidity, or the institutions will be, right, to get long in that previous zone. And that increases the probability of this being the POI that breaks out. Okay, we can see that here. This zone down here had no liquidity to the left, nothing built to the right. So that ends up inducing buy side liquidity for the extreme POI. That's the one that holds, and there we go. Okay, so that's if we have available liquidity to the leg in the left, or if there isn't available liquidity in the leg to the left, we can see it built to the right. Okay, here, no immediate structural low in the leg to the left. So we see those clear equal lows that also broke structure built to the right. Now there's available liquidity for those long positions to be filled. Or ideally, you get it both on the left and on the right, and then you get a high probable POI. Now, you need to systemize this. You need to know exactly what is mechanical definition for where you can see inducement build, okay? You need to have mechanical rules for that. If you're going to use inducement on the leg to the left, how near to your POI does that need to be? You need to have mechanical solutions for that. When is it relevant? When is it not relevant? On what time frames is it relevant for you? Can you use it on your lower time frame? What phases of the market, okay? These are all things that you need to make as systematic as possible, and that's what we have done with our trade plans, okay? That we have with our community. They know what to do in every scenario, and they have exact mechanical rules for this. Otherwise, you can end up just justifying every single move in the market. Inconsistent actions, inconsistent results, okay? We need to systemize it. Okay, so a quick example here on the chart, right? We are clearly in a bearish market. Now, as price is coming into this zone here, what do we notice? Straight push, no liquidity in the leg, okay? No strong liquidity is built in the right. None of these highs break lows. So what ends up happening, the only available liquidity is behind the zone itself, okay? We see this high and this high get swept, and eventually that produces enough buy side liquidity, okay, for the big guys to sell against to fuel that next movement to the downside, right? We get a new structural range to work within. Okay, cool. We want to try and capture those shorts. We've got one zone here and then the extreme zone here. What are we looking for with our liquidity requirements? That's a straight push. There's no structural high here in the leg. Nothing is built significant to the right with the rules that we use. So where is the available liquidity? It's behind the zone itself. That acts as the inducement for the extreme zone, and eventually we get the move that goes to the downside, okay? We get some corrective Asia price action coming into London next day, right? Let's zoom in. We can see here, nice supply chain forming, but there's no available liquidity in the leg. So what film builds to the right? We have a high that breaks a low, okay? And what does that do? That induces buy-side liquidity behind that strong high, now increasing the probability that there's going to be institutional shorting potentially from here to fuel that next movement to the downside, okay? We get another break of structure. Here's our new structural range we're working within, okay? Now, we have a zone here. But what do you notice? There is a straight push here, right? There's no available liquidity in this leg. So what do we need to see? We need to see strong liquidity built in the pullback, right? To increase the probability that this zone may hold. Otherwise, where is the available liquidity? It's behind the high itself. So what ends up happening? That high ends up breaking, okay? And then there's enough fuel to fuel the move to the downside, okay? No liquidity to the left, nothing built to the right. That high gets swept. Now the big guys can get short, potentially using that buy side liquidity to fuel that next leg. You're starting to see now how all of that logic starts to tie together to help you formulate trade ideas, to help you increase the probability of what you expect. But again, you need to combine this with all of the elements that you use in your trading. It is not going to solve your trading on its own. So how can we start to take advantage of these concepts with our entry models? Now, imagine you've done all of your higher time frame analysis and you found a really strong bullish idea, okay? You have your M15 zone and now you're on the M5 and you want to look for your entry model, okay? So entry model 1 would be you wait for your strong liquidation to occur. Well, what do we have? This low here broke this high, so it's broken some structure. That now gives us strong available sell side liquidity below that low, potentially for institutions to use coming into our POI. So now we can refine the POI to potentially increase our risk to reward, right? To this zone here. And now perhaps you want to set your limit order here. And that would be an example of entry model 1, okay? And you would look for price to tag you in. Let's see, okay, and you would now be in the trade, okay? So that would be how you would approach entry model 1. Entry model 2 is you're not gonna leave your limit order there. You're gonna wait for the market to start to move back in your favor, and this is where you can trail the candles, okay? Once the liquidation occurs, you trail them down, and you're looking for price to take you in. But again, you need to have very mechanical rules on how you do this. How do you size your trade? When does the trade idea get invalidated? Okay, you need to know exactly that. And also, sometimes this liquidation isn't going to be very near your POI. So you need to have a mechanical way to decide how near that needs to be. Okay, so that would how you would do entry model 2, and then you get tagged into the trade. Okay, but again, the downside of this is price can mitigate here and push down lower. We don't know that. So that's where entry model 3 comes in. If you prefer that, where you wait for the market to clearly shift, okay, then we get the movement to the upside. So now you would look for price to pull back in whatever way you want to do that, okay? So either you can look to enter on that extreme demand zone. Some of you might want to use Fibonacci's, okay? So you would have like the 618, whatever you want to use. Some of you want to use fair value gaps, whatever that is. This entry model is great for the amount of confirmation that you get. But here's the risk, right? Let's say you're entering on the extreme. Price doesn't always pull back to tag you in and you can just miss out, okay? So you need to pick the approach that works best with your psychology and the one that you find you have most success with over time. Test, and test some more. Now, the concept of high and low resistance liquidity can be really useful just for us to anticipate how price potentially may behave, okay? So imagine you have a bearish market. Now, when price starts to pull back, if you see that it just leaves a lot of corrective lows and there was no liquidity sweep once that pullback forms, that's often a very good indication that the overall pullback won't be that deep because institutions have not had the opportunity, right, to use the sell side liquidity that's generated below those lows in order to get long and fuel that deeper move. So usually when you see that, a low form like this, price won't pull back that deep and it will come into a less well-priced zone, okay? And then that's usually if you get like a strong liquidation around this POI, you can trade it with more confidence, even though there's cause for higher prices, because we now have that resting liquidity to target to the downside, right? That low resistance liquidity. Whereas if a low forms with a strong liquidation, often, not always, often that can be a sign, right, that this move was generated with that strong institutional activity using that sell side liquidity to get long. And that's very often where you'll see a much deeper pullback and therefore you can use that as information to potentially not trade this POI, or to only expect a quick reaction and expect price to come up to those more premium levels before we see that movement there to the downside. So in this example, we are in a clear bearish trend. We're pretty oversold to the downside. Now there's no strong liquidation here, and price is pulling back pretty correctively, okay? Leaving a lot of resting liquidity for price to target. Now, when I see that type of price action, that's a pretty good indication that we're not going to see a very deep pullback in most occasions, right? So that means you can be a bit more aggressive with your shorts, shorting at more discount prices, right? Now, obviously, again, this concept on its own is not that useful. You need to combine it with everything else in your analysis, right? Obviously, if we're coming off a beautiful high time frame level, things like that, then, use a bit of common sense there. So we see price start to push to the downside and chop around that low. Now, what happens here, okay, is if I zoom in, we sweep, or not price sweeps this significant swing low here, right? And we get a liquidation of that low. But what also do we get in the immediate price action? This low here broke this high, so it's somewhat of a strong low, giving us another, inducing even more sell-side liquidity below this low and this low here. And now if we start to see price shift to the upside, we can start to anticipate that institutions are now going to use that to fuel a much deeper pullback, okay? And this is just a really good concept that you can use to now anticipate how price is likely to behave, right? So if you see that, you can now obviously see that this is likely going to be a trap and anticipate we can play a much deeper swing pullback because there is now available liquidity for that to occur. So now to bring everything together that we just learned, we're going to look at one of these sort of schematics that I was taking the piss out of at the start, but I'm going to try and simplify it for you and pay attention to what actually matters in your trading, okay? So imagine we are in a clear bearish swing trend. Really what we want to be doing is trying to capture the shorts here to get that lower high for that next leg, right? So as price is pulling up to two of our main POIs here, now we want to be thinking about liquidity, okay? If there is no available liquidity in the leg to the left, we want to see it built to the right. None of these highs break structure, so we don't have any liquidity built, okay? People might get short here, which is fine. Price then shifts structure to the downside, taking out this liquidity below these lows, okay? What is that going to do? That's going to induce people to now want to sell from here, right? Because they've seen that mitigation of supply. They've seen structure start to shift in their favor. So what are they going to do? They're going to want to get short. They're going to get short here, stop losses above the highs, right? So what is that doing? It's inducing buy-side liquidity above that, okay? That now institutions can potentially use to get short once price wipes out that liquidity, right? So all of that liquidity builds above a high that broke a low, above these equal highs where other people are now selling the double top, okay? And now we have that. We have the induced liquidity, if I get rid of these lines, into our extreme level. So this can be that first potential entry in which you want to get short, okay? Maybe you want to wait for a bit more confluence. So what can you wait for? You can wait for market structure to shift back in your favor, okay? So now order flow is bearish, and now you have a higher probable POI to trade from, right? Obviously, there might be multiple POIs, but use your knowledge. No liquidity to the left, no liquidity to the right. Where is the available liquidity? It's behind the high itself. This now becomes a higher probable area to short, okay? What do you have? You've got double bottoms here for liquidity to target, okay? Because before that, what you'll have is people will see this low will break this high, okay? They don't understand multi-time frame analysis. They don't understand what's going on. When price then comes back down into this double bottom here, what are they doing? They're trying to get long, okay? There's all sorts of madness and reasons as to why liquidity can be generated everywhere. There's so many different ways you can look at it. You don't really need to worry or get your head around it. What you need to identify is market structure is giving me my direction. I've got well-priced POIs I want to trade from, but I know that I need to see either liquidity to the left or to the right before I'm going to get involved. And then it's down to you whether you want to wait for more confluence, such as waiting for market structure to shift back in your favor. Okay? So there's a lot of different ways you can cut and slice this, but we have very, very mechanical rules on when we will use liquidity to the left or when we ignore that and we must use it to the right, how near it needs to be, what we need to see exactly for our entries, and when a trade idea is invalidated. You need to have that very, very clear, okay? So if you want, if we've done all the hard work for you, If you want our mechanical trade plans, you know where to get it, right? You can sign up to our community down in the description below. But there is tons of information now in this video to help you think about what's relevant, to help you think about how to make it mechanical. And it's up to you now to use what you resonate with, test it. Consistent actions leads to consistent results. That's how you